I think we might start off as we've got a few people there. So it's first quarterly review for 2023, and as usual, I mean it is really statistics up till the end of December, but generally speaking, and this is no exception, we take them right up until yesterday basically, on any data that's more current, so that everyone's got a very good picture of what's actually happening right now in the various markets around Australia, because I'm sure most of the people watching this would know that there's been a lot of change. I mean, a lot of things are happening at the moment. There is a lot of fluctuation and volatility in many asset markets. I mean, good Lord, if we look at, say, fixed income, bond rates have been up and down like a yo-yo. So we're seeing that in many asset classes, and there's obviously a lot of movement at the station in terms of what's happening with the banking sector in Australia, lending, interest rates, inflation. So we'll go through all of that, and obviously there's a disclaimer there, so people should read that. This is general information, so it's not personal advice, and I think everyone that knows us knows that, but for everyone else, please look at the disclaimer to make sure that you know what we're covering. Just a little bit of if you like, background about the organisations. So we have a number of various businesses. Wise Guru is the international consulting business that primarily seeks to assist Australian expats around the world with many of their finance needs and property needs, and all of the various, I suppose, professional functions that revolve around trying to acquire a property in Australia, be that for investment or in many instances people wanting to buy something that they're going to live in either now or in the future if they're Australian expats. You can see there some of our other businesses. Aussie Loan Guru, which is the lending business. Australian Property Guru is the Australian real estate business, and Unicorp Partners is our advisory business, which is domiciled in Sydney. And again, we deal with people all around the world in relation to their various needs. You can use one of these functions. You can use all of them. It really depends on where you're at, and if you're going to stay offshore for a longer period of time, come back, or you're looking to go offshore. So all of those things can be dealt with, and we can assist most people. In terms of who our clients are, look, the demographics, I suppose, are fairly similar in many ways, because you might be a banker or a software executive, or our domestic clients, which are quite often medical specialists or people in the legal profession, but they're all, we are all very time poor, and we need help. People need assistance, and we find that most of our clients and many people in general like to acquire property, and we look to assist them with their Australian property acquisitions. So look at our team of professionals that we can send people to for all sorts of various things that one should have when we're looking to buy a property within anywhere, not just in Australia, but mainly so. So these are the things we do. We have a concierge service, which is really designed for investment property. So if people are looking to purchase something in Australia, we can assist them with that whole process, and it's a bit of a hand-holding process to help people through what sometimes or usually is a bit of an anxiety-producing situation, from sourcing something right through to settlement. And most of our existing clients will obviously know about that, but certainly for anyone who's listening and who isn't, then please, by all means, get in touch. We can explain that to you. So what are we being asked at the moment? This has changed a little bit since last year, but still, most of the questions we're sort of fielding, I suppose, at the moment are about interest rates. Where is the official cash rate going to end up? And this is something that's obviously a topic of great discussion in the news, and changes from quite often week to week. So, as I've said, we've seen lots of changes in expectations, in people's expectations revolving around inflation, and clearly the RBA, the Australian Central Bank, is trying to remove the thrust of inflation. I personally think, excuse me one
You're
moment.
on mute, Andrew.
Sorry? Let me just, can you hear me now?
Yep.
Perfect. So, most of the things we're seeing, and now I suppose the other thing that's cascading into this is that a lot of people who have been on very low interest rates, fixed rates, are starting to roll off, and that's another big conundrum, not just for borrowers, but also I think for the regulators, for APRA, for the RBA, for the government, because it may impact financial stability of the banking system. So nobody, and the banks included, want to get too many people, too many borrowers into financial distress. And I think there's a lot of work going on in the background to start dealing with some of the possibilities about how the banks can manage this, how they can assist borrowers, because it's it's a big deal. People coming from a rate of maybe 2.5% and going on to a rate of 5.5% or 6%, depending on whether they have an owner-occupier loan or investment loan, etc. These things are what we're seeing at the moment on that side of the equation. And then on the flip side of that, people are saying, well, look, what are the opportunities that this market is going to bring us? Where do we see growth occurring? What are some of the intrinsic drivers? Are there any bargains to be had somewhere? Are people still going to stay working from home, or are they going back to the office? The borders have reopened. Where's immigration occurring? How important is it? How large is that? What about interstate migration? So they're the questions we'll cover, because they obviously impact housing demand and thereby housing prices from both the purchase situation and also in the rental markets. As we all know, Australia's pretty big, so we have to look at research in all the various areas, because as you'll see as we go through, what's happening, say, in Perth is different to Sydney or Melbourne or Brisbane and so forth, and really important to get a handle on what's happening there. And there's lots of, as we know, there's lots of numbers and lots of information that we have to collate, and we look at it every day, and a lot of it may be actually conflicting. So we have to try and put a practical overlay over all of the information that's being dished out by the various sources, and we use a lot of them, the ABS, Core Logic, etc. So stats coming out all the time, and we look at what's happening in terms of trends as well, because I know if you look at seasonality at the moment, you've got the spring selling season in Australia, so February, March, and last weekend Sydney auction clearance rates were 78%, and we haven't seen that for a long time. So lots of things there that are perhaps not what one would expect, and this is really, it revolves a great deal around this. How much further is the RBA going to raise the official cash rate? As we all know, in February there was another 25 basis point increase, so it's now 3.35%. My feeling is that the RBA will increase by another 25 basis points next month in March. And then potentially, I think, one more rate rise after that, because we're still having that lag impact in terms of the rates that have been raised over the last 9 months coming through and flowing through to the consumers, and the full impact being felt. And plus, the RBA is different to, say, the Fed in the US, where I think the mortgages that are coming off fixed rates, and there are some 900 million of them, are going to impact the consumer behaviour, consumer spending, and I think that potentially core inflation has peaked anyway in the last quarter. So a lot of those things playing through, yet the RBA certainly don't want to lose any further credibility by letting inflation expectations become entrenched, and that's their big mantra at the moment. So if we look at these things, interest rates are increasing for everyone. So whether you're on a variable rate now or on a fixed rate, and that's going to roll off, clearly it's going to increase whether you're an owner-occupier, owning your own home, or an investor, just at slightly different rates. I suppose the people that have rates that are still fixed into, say, late next year might be very fortunate insofar as that they could weather the sort of peak of this current rate cycle. That obviously remains to be seen, but I think that's not a silly bet. So in the meantime, of course, we have to help people as they roll off these things, and I'll show you what's happening there. If you look at this slide here, this is just from Westpac, second largest home lender in Australia, and as you can see there, there are large portions of these fixed rate loans rolling off during the course of this year. It's already begun, and then as we head through to the middle of the year, there's a lot more coming off. And on the right hand side, that's the difference. I mean, Australia is a nation that's generally had borrowers on variable rate loans. In the US, I mean, the vast majority, over 90% of people are on fixed rate loans, quite often 30-year loans. So very different there. You're only going to be impacted if you're buying a new residence, so selling yours and buying a new one and taking out a new loan. In Australia, that impact's quite different, and I think will obviously assist the RBA in relation to potentially bringing inflation down more rapidly. These are some of the latest forecasts from Westpac, and if you can have a look there, if you look at the cash rate, Bill Evans expects that to go to 3.85 in June and then stay there until March of next year, of 2024, when you start seeing some reasonable declines starting to come through as the RBA winds back that official cash rate. 10-year bonds, if we look at those numbers, they've been moving up and down very rapidly, getting closer to 3.95% now. Same's happening in the US. So and if you look at, say, 2-year yields in the US, I mean, they're closer to 4.8%. So there's a lot of movement at the station. It's something that everyone needs to watch. And I suppose the other impact that we find in Australia, it's FX impact. And if we look at the Australian versus the US dollar, the Westpac view is that's going to improve over the next year and then the following year. I think the same, and I've been saying this for a little while. I think that we have the tailwinds of commodities that are being required, and I think that's going to increase not only as decarbonisation continues, but I think if we look at what's happening on a geopolitical basis, there's going to be a lot more spending on defence, so military equipment, China reopening more quickly than many thought. I think all of those things are going to continue, and there's been less expenditure on exploration in relation to most commodities that are required. So I think there's going to be some squeeze in supply as well, and that bodes well, I think, for the Aussie dollar, not just against the US dollar, but against a basket of currencies. So the other question we had there, what's immigration doing? And it's having a big impact, I think, because if you look at the rental markets in Australia, I mean, they're really tight. So this is from the latest figures, and don't forget these are lagging indicators and lagging statistics, so at least 6 months old, generally speaking. But what we've seen is this very sharp rebound, much sharper than the ABS or any of the government bodies thought over the last year, which is occurring. And anyone that travels to Australia from overseas would be able to attest to the fact that, as I see, all of the aircraft are full and generally filled with many young people. There's a lot of immigration coming here, a lot of students coming here from India. We haven't seen the impact, I think, just yet from China, but that's building and coming. And just in general terms, immigration's running very strongly. There was an article out in the AFR today where they were talking about the airports in Sydney and Melbourne and Brisbane. Melbourne's doubled its number of passengers from a year ago. Sydney more so, went up to 3.2 million, and Brisbane went from 740,000 to over 1.7 million. So, those numbers are still below pre-COVID numbers, but they're rebounding very strongly, and I see that continuing to grow as more airlines add supply. And I think that's been one of the constraining features, because, again, most people that watch this would know that airfares are certainly not inexpensive at the moment. So if we look at the situation within the states and territories, Victoria has now rebounded, come from negative population growth back to positive, which is great, and a lot of that's obviously centred around Melbourne. But if we look at where the largest population growth will continue to grow, it's forecast to be in Queensland, and big rebound in Victoria and Western Australia. So interesting to keep looking at that, because obviously we saw a lot of that interstate migration occurring prior to the pandemic, and I'll come back to why I think that'll continue in certain areas. The other metric to look at is new lending for property purchases, and that fell in December 4.3%. But it's interesting that as you can read there, half of that decline came from owner-occupiers who are not first home buyers. So, big slowdown there, and people perhaps upsizing or right-sizing or downsizing, whatever they were doing. And again, I'll come to where I think some areas will feel the brunt of the rise in interest rates more acutely than others, putting pressure perhaps on housing values in those regions. This is something else that certainly APRA looks at, and we do too, in terms of what type of lending is occurring. And the trend we've seen there for some time has actually been quite conservative, really. So the banks look at riskier loans, inverted commas, so high LVRs, high interest-only debt, high debt-to-income ratios, etc. But that hasn't caused anyone any great discomfort at this point in time. As we can see, some of it's trending lower, and the banking system seems to be in pretty good shape. So, if we look at property as an asset class, it's a very significant one in Australia, as you'll see. And let's see what's actually happened to these values. This is up to January. So national home values have declined 7.2% over the year. And that's, a generic number. Clearly, it depends on where you look in relation to how that impacts things. But I think it's important for people to recognise that, there are so many different components that make up this, if you like, aggregate number, that you really need to look at the underlying situations to see where this is occurring. And we'll go through the states in a minute. But the other important thing I think to note is that the pace of declines the trend has been that that's slowing. And this is, I guess, primarily aimed at the East Coast capital city markets, because they were the first to go up and the first to go down. So that rate of decline has eased, especially, I guess, important for people, say, who have property in Sydney, because that had a stellar rise and also had a very quick fall. And if we look at, pardon me, the 12 monthly changes there, as we can see, it's fairly different. So if you have a look here, Sydney's down 13.8%, Melbourne 9.3%, Brisbane 4.7%, Adelaide's still up 6.9%, Perth 2.7%. So really, it's not a very uniform situation, in fact anything but. And then if you look at capital cities as opposed to regionals, the rest of state, again, a pretty big difference. And that just underlines the importance of research. So if we look at it with a bit more granularity, if you have a look at the various value segments, in the 3 months of January, the declines have really gone across all. So the lower quartile, upper quartile, and the middle, everywhere except Perth, where you can see Perth is still pretty much line ball, as opposed to, say, the East Coast capitals, which have seen large declines there, and Hobart also. The other impact that needs to be looked at is, I think, really important for housing, because it's supply and demand, and it's not just a speculative asset. It's actually something that people need to live in, to inhabit, and this is where the immigration picture again is so important. It's a bit of a jigsaw puzzle how all of this fits together. So if we look at that, dwelling approvals were up 18.5%, but they're still way below long-term averages. Most of that was driven by apartment approvals, and they can be down 20% as they were in November, and up 20%. So I still feel that there's going to be quite a lot of pressure on that sort of higher density housing coming through to the market quickly enough to be able to accommodate a lot of these, so particular younger people and students that are coming into Australia, because they will have to live somewhere. And all you have to do is speak to anyone who's looking to rent somewhere to live in, say, Sydney, particularly Brisbane, also Melbourne to a slightly lesser extent, but everywhere, they're finding it really difficult to find somewhere to live, and they're having to pay a much higher price than they were 12 months ago. So, let's look at the rental market, because it's really important for everyone, for investors, but also for people just trying to live and work somewhere where their employment obviously is close by and they've got the amenities that they need. So if you look at unit rents, they really have shown a big rebound through 2022. As you can see, they're up over 10%, just over 10%. And if you look at some headlines, annual growth is from CoreLogic has eased by 0.01%. So total growth was 10.1% for 12 months of January. It was 10.2% to December. And a lot of that's been driven, as I say, by rental values for units in Brisbane, Sydney and Melbourne. As you can see there, again, a bit like the other chart we looked at, there's a great deal of variation. However, it's all heading one direction here, and these are the increases in rents in the various capital cities. So very strong rental growth, and also, I suppose, not quite the same. Yields have increased, and the highest since November 2019. But some of that obviously is to do with the actual asset value, the value of that property declining. So you have had big rental growth, but you've also had property price declines, so the yields are climbing through that. And again, as you can see there, there's quite a bit of difference between the various cities, but Sydney especially, which was always languishing in terms of rental yields, is now above 3%. So lots of data, as we always know and look at. What does it tell us? How do we use it? What can we do with it? And if you look at this slide, Australian residential real estate is currently worth $9.2 trillion in Australia. It got up to just under 10 trillion last year at the peak. But I think the interesting part here is, when I speak to people, it's in relation to the outstanding mortgage debt against that is 2.2 trillion. So if you speak to the average person that has a large mortgage or several loans, human nature being what it is, we all think that everyone else is in the same boat. And as those numbers show you, clearly that's not the case. So many people don't have a mortgage on the house that they live in. And if they're not properly structured, they may not have a loan against their investment property either. But it's one of these things that people forget and don't realise. And also the flip side of the coin of rising interest rates is that for all the people that have saved up, perhaps the somewhat older people in the community, they were getting no interest on their term deposits and on their savings over the last 3 years. So they now are, and that of course adds to their ability to consume and to spend money. So lots of things to think about, and this is one that I always put up because people ask me from around the world, what do you think about the Aussie property market? And clearly there are so many of them. So it's really important to try and get some clarity around that, some granularity, get some research, because most of these markets are different at any given point in time. We look at history, not that potentially it repeats itself, but certainly I think it's worth for any intelligent person to have a look at that. And if you have a look at the peak to trough declines that have occurred, they've become deeper since 2004, and this will probably be the current cycle that we're in will probably be certainly the deepest to date, and who knows what happens going forward, but I think it will be the deepest to date, although I'm not really convinced that we're going to have the 25 to 35% price declines that a lot of commentators have mooted in the press. So let's have a look at some of the other underlying data, which I think is realistic to consider. And if we look at housing price performance during tightening cycles, so when the Reserve Bank's been tightening or the Fed, central banks have been tightening, we can see it tells, shows a mixed picture, doesn't it? Where you've got both declines and increases, and they may have lasted for longer or shorter periods of time, but I think it's important to recognise that this is not all a one-way street. Especially important for people who think that there's a situation where at a certain point in time everyone has to sell their property and someone can buy assets for half price. I don't think those sort of situations are going to occur. If we have a look at this is something that I said a year ago. What I see happening is a decline in transaction numbers and a decline in stock levels, and that's a pretty good summation of that. If you have a look at it now, currently at a national level, stock on the market is over 30% less than the 5-year average, as you can see there. So pretty important, and we again do our own research from our own client base and speak to anyone, especially in areas that are sought after where they're looking at to buy quality assets. It's really hard. They're finding it difficult. They're not finding a slew of bargains out there. And when we speak to the banks, we can see the same thing. There are not really any indicators yet of many distressed sales. And I'll come back to the situation later, because I think some areas may suffer from that, but many won't. So if we look at the scenarios in relation to where housing prices may end up, they're very different. And this is just looking at the capital city markets. But if you can look at where we're at the moment, for example, if you had a 15% fall in Sydney, takes you back to April 21. Melbourne will take you back to April 17, and Brisbane October of last year. So if you have a look at those scenarios, they're very different for each capital city market, and I think that's something that people need to also bear in mind, because certain markets have seen a very substantial increase in values, particularly over the COVID period and just prior to that. And so there again, granularity is important, because you'll see segments of capital city markets, various suburbs, that have had gains of 50, 60, 70% over a period of time, where others haven't. So you'll tend to find, generally speaking, that the rate of decline in those areas should be and will be faster than in others, but ultimately the level that they settle at may be again at a higher high, and I'll come back to this. So if we're looking at it from now, this is current data, how far would dwelling values need to fall to get back to pre-COVID levels? And as you can see, on a national level, it's another 13%, but if you have a look at situation for combined, the combined regionals, it's another 24% basically. And if you look through each of the states, capital city markets, and the rest of state, you can see there's a wide variation. So the interesting one is Melbourne. I'll come to that in a minute. The other thing that's important, I get a lot of people asking me about this, is, no one has a crystal ball, of course, but what's going to happen going forward? And at some point in time, obviously central banks will stop increasing the official cash rate. Generally speaking, in the past, usually central banks have erred on the upside and have raised too far, and generally, that's caused recessionary periods to ensue, and they've had to cut rates. So if we look at things, perhaps not, if we see the house price change 1 year after the last hike, that's not as important, but as you can see, it's mixed. Minus 4%, minus 4.6%, up 14%, and virtually flat. But if you look at things, say, 2 years after, in 2009, we had house prices were still down 1.2%. But if on the other declines, we're up anywhere between 2 and 33%. And if you look at the 5-year numbers, they're pretty positive. 64% being the high and 13.5% being the low. So it's important to recognise that these things are not linear. Sometimes you might wait for quite a number of years with certain markets where they won't really do much, and then you get a period of accelerated growth or decline as in the situation. So depending on what you're looking to achieve, if you're looking to move into a new home and you want that area because your kids are growing up and want to go to certain schools, then I think it's important to look at this because you recognise that over the medium term, there is perhaps not so much to worry about as people do. People are always worry about losing something, fear of loss more so than the fear of gaining something. And I can obviously send this information to people when they contact us. But if we look at things from an investment viewpoint, the property situation, we always use this and say it's as easy as pie, which refers to, if you're going to buy something, make sure there's good population growth there that's sustainable and going forward, that good infrastructure already exists, or lots of new infrastructure is both in the planning stage and currently being built, and you have strong employment growth. If you've got those fundamentals, and you're buying a quality housing asset, you should do pretty well with that. So if we look at various markets now, if we look at the capital city market, Sydney, it's always had the most diversified economy in Australia. New South Wales has. There's still, there's obviously the highest downward pressure has been in Sydney due to A, where prices rose to, and B, the affordability situation that created, or the lack of affordability, and that's still in the market. I think Sydney's still leading the pace down, but as we can see over the last number of months, that rate of decline's been slowing. There's still ongoing demand for quality. Ask anyone in Sydney looking to buy property that's we call it the inner middle ring. So those easily accessible quality suburbs that have great amenities. No real bargains, and difficult to find the type of property that you're after. Another quarterly housing price decline, as you can see there, 3.9% for the quarter, 1.2% for the month. And housing prices in Sydney are now 13.8% below their peak, which was reached last January. So a reasonable decline, but it had a very large upturn in the prior 3 years. Melbourne, slightly different, and it's been different also due to the extended lock-up periods they had during the pandemic. But population growth has commenced again there, thankfully, so the outflow has ceased. It's actually the cheapest capital city on a median basis to rent a dwelling in currently, which is, quite amazing in some respects. The pace of decline is slowing there, and obviously because Melbourne did very well, always has done, in terms of, proffering its tertiary institutions to overseas markets. A lot of students returning to the Melbourne situation, and they're needing somewhere to live. So if we look at that though, Melbourne's actually it's getting close to where it was prior to the pandemic. It's down 9.3%, down 3% for the quarter and 1.14% the month. So, that's getting close to now eradicating its COVID gain, if you like. So it'll be interesting to keep an eye on that over the next couple of months. If we look at Perth in the west, things have been going pretty well there. Obviously we've got a lot of strength from commodities employment and other ancillary industries that revolve around that. Very low vacancy rates, as we have in most capital city markets around Australia. It's a minimal quarterly decline, I'll show you in a second, and the lack of diversification of the economy in WA is being a positive for quite some time now. So if you'd see that on a quarterly basis, market's down 0.1%, so call that flatlining, down 0.3 on the month. And over the last year, values are up, 2.7%. So Perth has done well, different markets. So the peak was, prior to that was, 8 years ago during the mining boom. And things look good there in relation to, I suppose, affordability. Perth is far more affordable than many of the other capital city markets. And I think, people there obviously much happier with that outcome currently. So a question that we often get is, old versus new, what should I do? Whoops. Should I buy an old property or should I buy a new property? And there's no right answer to that. I mean, you can buy one or the other and see what transpires. But for most of our clients, as I said originally, they're pretty time poor. They also earn higher incomes, so tax deductions are beneficial for them. And they don't want to be dealing with either their property manager or the tenant in relation to repairs and maintenance. So generally speaking, if you buy a good quality new dwelling, you're not going to have any repairs or maintenance issues because any major maintenance will be warranted. You quite often find better tenants and it's easier to rent and manage overall. So that tends to be what our client base likes. But let's say, you might have been in the construction industry or something affiliated to that, and you're nearing retirement and you have a lot more spare time on your hands and some expertise. You could buy something that's old and add some value to that. I guess the current scenario in Australia is probably not helpful for that because, it's hard to get people, trades to come and do that work, and prices are still going up, so pretty difficult. I was mentioning this earlier, tax implications are important, and we have a particular system in Australia where we get Division 43 and Division 40 tax deductions that, Division 43 lasts for 40 years and one can deduct 2.5% of the capital improvement value each year for 40 years. So pretty important, makes a difference for many people, and whether you're an expat or not, you can utilise these benefits just slightly differently, perhaps from a timing viewpoint. So the numbers still, people who've been watching this for a while will know, but to us the numbers are still indicating that southeast Queensland is probably a good place to look at in terms of investment. If you look at Brisbane, it has a diversified economy. It's a close sort of comparison to the Australian economy as a whole. The work from home lifestyle has driven extra population growth from the other states there, and that seems to actually be holding pretty firm. There's an even more substantial valuation gap if we look at it, say, compared to Sydney these days, because prices have moved up everywhere on a nominal basis, and it's had the strongest interstate migration for the past 15 to 20 years, and that's continuing. So a lot of those fundamentals are still there. If you look at the pace of declines, that's accelerated in the last 3 months. So down 4.8% for the quarter, 1.4% for the month, and over the past year, dwelling values have fallen 4.7% there. So Brisbane values are now, as you can see there, over 10% below their record high, which was in June last year, but still enjoying some of the, I suppose, underlying fundamental growth factors that we look for. So if you look at population growth there, some of the latest numbers there from the MB.BS, have a look. Queensland change over the previous year, 2%. It's really strong population growth, and Western Australia there at 1.3. So these are figures that we look at because Australia being such a large nation, interstate migration is a very important factor. It's not just immigration from overseas, as you would get, say, in countries like, say, Singapore. So if you look at that on a graphical basis, most of the people have been leaving New South Wales, and most of that input has gone into Queensland. So you can see that continuing. We see it continuing. We look at it on a quarterly basis, and it'll be interesting to see how much longer that continues to show that trend for, but it's not showing any signs of weakening at this point. If we look at the infrastructure, so the pie, population growth, that's strong. Infrastructure, there's a slew of infrastructure projects that are under construction within Brisbane, southeast Queensland, and quite a few more in the planning stage, but some really, I suppose, significant changes there. So last year, the Brisbane Airport parallel runway was completed, and that now gives it the capacity of Changi in Singapore or Hong Kong, and clearly at this point in time that isn't being fully utilised yet, but it will be as we see overseas travel continue to grow. And in Queensland, the Chinese tourist was actually a very important factor. Currently, less than 10% of where they were, so they have a long way to get back there, but they've now got the capacity to deal with that. So lots of really important infrastructure projects that are going to improve the state economy from Treasury's outlook there, and that'll be ongoing for many years to come. And if we look at the Olympics, when we're speaking of many years to come, Brisbane won the Olympic bid for 2032, and even though that's it's almost a decade away still, the infrastructure projects that go along with hosting that event are commencing now and will continue for many years. So that's going to bring both short and long-term employment growth to certain areas within not just Brisbane but within southeast Queensland, and we think that's going to keep driving the local economies positively, and will impact obviously housing values because they will require more housing to be established. So if we look at what is the value proposition, generally speaking, we try and help people avoid the mistakes that investors commonly make. Sometimes wait too long, people go, oh gosh, I just want to invest, anything will do, I want to get into the market. Ignoring your point of difference, which is really silly. You should think about a point of difference. There's no lack of information or research out there, but trying to utilise that can be very difficult because quite often it's just too much. Waiting too long to invest, so you can research things for years and come to the realisation that you probably should have done something quite a long time ago. And the other mistake that people often make is buying into a really strong market, so close to its peak, you're better off buying into a strong market of the future, we call it. And to get that right, you obviously need to research those things. So, when you look at that, any property won't do, and we see it with a lot of the mining regional markets where a town may be reliant on sole commodity, as it were. And I just pull Port Hedland there because I know that market from many years ago. Or it could be, high-rise apartments that are undersized and compromised floor plates that are just made for investors, whether that be in inner city Melbourne or Surfers Paradise or wherever. There's no unique attributes to that. It's not the sort of property that owner-occupier, Australian owner-occupier would want to live in. So, they're not going to give you the sort of outcome that you should be trying to look for. We look at further granularity, on the supply and demand side. This is in relation to Brisbane. There's just very little new supply coming to market, and that's been caused, I suppose, by the constraints that the economy has brought upon the construction industry. So labour shortages, input costs going through the roof, no real clarity going forward in relation to some of that. And I was speaking to someone just the other day, and they're saying, oh yeah, I'm going to do these renovations, and it's going to be easier, I'll be able to get people to do that. But they forget that a lot of the infrastructure projects that have been created by government and by fiscal policy are actually taking a lot of those tradespeople out of the marketplace where they would have normally been able to deal in the private sector. So something to really look at. The other area that's been relevant for the last 2 years plus, perhaps, certainly through the COVID situation, and prior to that to some extent, and certainly more important now, people want to live in areas that have more space. So if you're going to live in one of those inner middle ring suburbs in the major capitals, and say you're looking at living in an apartment, we find that, say, if 3-bedroom apartments are very sought after and in short supply, or 2 bedrooms with a multi-purpose room, sort of things that people are requiring, or they want to go to a home. And it's not always the case that they have children that occupy those rooms, they just want more space. And I think that will continue. So, tying all that together for everyone, we try and look at all of the drivers for property markets, not just in the short term, but in the medium and long terms, because that's what you need. And then if you look to buy an asset, make sure that it does have some future sustainability and some unique attributes. So you're not having some little apartment in a block of 1,000 that 700 of them are all the same. Make sure you've got employment growth that's going to continue, infrastructure growth, all those things that I think are going to stand people in good stead over the long term, and property is a longer term investment. So if we look at this year and beyond this year, what are some of the opportunities, and we look at things like this. So that's, these are these sort of more bespoke properties that are built for the owner-occupier market, and we call it the inner middle ring, so say 3 to 13 kilometres from any of the major CBDs. The other markets, this is on the Gold Coast in Queensland. Also townhomes, something that people are it's a sought after product, because again, not really readily available in those sort of areas because you just don't have the land to do that. Then if you look at the other coastal markets, show you this is the Sunshine Coast in Queensland as well. Those sort of markets have been very strong. Rental returns have been growing very strongly also. Vacancy rates are very low, and I don't see that changing a lot because there's not a massive amount of supply coming online. Although you do need to do your research and make sure that you're looking at areas where there isn't potential oversupply, and that's why we always also recommend that people are very wary of CBD markets, because that's where over the past decades that's usually been a situation that has occurred in those regions. So they're just all examples of quality properties. We look at things on a quantitative basis for people. So we look at all of the costs of purchasing a property and the ongoing costs of ownership, so that people can get a fairly good idea quantitatively of what that entails, what that's going to look like, rather than just hoping for the best. And typically speaking, if you're an Australian property investor, you have a situation where you pay for about 6%. This has been over many cycles. The tax offices, if you get the right type of property, will contribute about 21%, and the 10 and 73%. So it's a pretty attractive scenario for most people, and it enables them to leverage their asset base over the years on a reasonably conservative basis. So for Australian expats, who we deal with obviously everywhere around the world, so it's slightly different, because the tax credits that Australian domestic residents can utilise each and every year against their other personal exertion income, expats can't, so they save that up. However, these tax credits have no half-life, so anything that you don't utilise along the way, so against other Australian taxable income, if you have other rental properties that don't potentially have a loan against them, or a low loan, you can use them to offset the income that you get from that, so you pay no tax overall, and whatever's left over you can utilise when you come back, repatriate to Australia in the future, against your personal exertion income, or perhaps if you're going to sell an asset and want to utilise it in that way. So just last thing, as I said, property is a long-term investment vehicle. I think it's lumpy, there are transaction costs involved, etc. And this is just an interesting, if you like, graphical presentation of what tends to happen in life. The highest nominal returns are from years 20 to 30, but the highest rate of transaction is here. It's sort of in years 4 to 8. So people tend to, as I say, spin the wheels too much. If you do the research and acquire quality assets in the beginning that are located in those sought after locations, and they have some unique attributes, etc., then you don't need to do too much. You don't need to spin the wheels, you just need to keep it. So the important thing is to make sure you don't, I suppose, overexpose yourself, and you can always continue to keep those assets and make it your choice if you actually need to or want to sell them. That's what one should do, rather than trying to capitalise on shorter term price movements, potentially incurring taxes that are otherwise avoidable, and keeping those assets and seeing how they can provide for you for the future. So if you look at an overall situation, we try and assist people in many ways. One of the most important ones, I think, is that we can help both domestic clients and Australian expat clients with up to 85% loan to value ratio loans without mortgage insurance, and that enables people obviously to increase their asset base perhaps more quickly than they would otherwise. Certainly, a lot of expat clients are limited to 70% LVRs. We make sure that we look at your situation and see what's going to work better for you, because like I said, we find that often people move offshore and they have a home in Australia. It may not have a big mortgage on it, may be getting a lot of rent, and they're paying a lot of tax when that could be structured in a way that would reduce or eradicate that and enable them to further their investment base. So lots of things there, but that needs to be dealt with on an individual basis, and we have to obviously look at everyone's situation as an individual and then try and assist them with that. But as anyone who is a client is watching knows, all you have to do is reach out, email us or call us, and we can arrange for a Zoom meeting to go through a situation as it sits for you and depending on what your goals are. If you hit the chat button, there's a survey there, so please, if you don't mind, complete that, and we can assist you with anything there. And if anyone's got any questions now, then let me know. We've got a couple that have been sent in. You can put them on the chat, or you can just unmute and ask me. I'll be more than happy to try and help out. Rod Jackson sent one in before. If you're coming off a low fixed mortgage rate over the next quarter, would you recommend staying on variable and wait for the cash rate to drop, or refix at the prevailing fixed rates? And Rod, great question. Look, I would potentially throw the dice and stay with a variable situation at the moment. The only reason I say that is, well, there are a couple of reasons. Fixed rates are, as you saw in that graph early in the presentation, are pretty high. And I don't think they're compelling value, because I believe that we're nearer to the end of the hiking cycle than the beginning, certainly. And I think it might be just prudent, as long as your cash flow is relatively solid, to wait and see what happens over the next 6 to 12 months. Because just, if I look at the volatility in everything at the moment, in all different asset classes, certainly in, say in bond rates and shorter yielding securities, there's just so much movement. I think inflation has peaked. So, if you're looking at some of these scenarios, I think the less aggressive course of action, the more conservative course of action, is to stay on variable rates for the time being, and also see what sort of products the banks may bring out over the next 12 months, because they're working with regulators. The financial stability of the banking system is at stake somewhat here in Australia in relation to this. So I think we might find there'll be certain products that will be launched that will assist people that aren't offered at this point in time, if that makes sense.
Thanks, Andrew. It makes good sense.
Yeah. Then
reinforce my view.
Well, let's hope we're both right. Who else has got a question there? Gary, any questions from you?
No, thank you, Andrew. Very good, informative and authoritative. Thank you.
Brilliant. Appreciate that. There was another question sent in from John Graves, and this one I'm not sure if I'll be able to answer that quite as well. But it's, how do we get politicians to accept responsibility for managing the economy? How to teach journalists to take a whole of economy picture and not headline grabbing negativity. Boy, there's a lot in that. The first part of it, I'm not sure we ever will be able to, in terms of getting politicians to accept responsibility. I think we can see a lot of that now, because if you look at what's happening with inflation, it's not just being created by consumers or by monetary policy. There's also fiscal policy. So, when governments were doling out money left, right and centre over the last couple of years, that's contributed to it. And so that's a government initiative. And I'm not saying, by the way, that it's actually was a bad one at the time, because I don't think anyone knew how to deal with the whole COVID scenario. But yeah, I don't think that politicians are going to come forward and tackle difficult topics such as this with any great sort of enthusiasm. In terms of journalism, well, that's never going to change, because you always see headline grabbing things. You'll see things like, I don't know, market crashes, market has declined by 0.2% for whatever asset that may be. Or, the flip side of that, I remember about, 2 years ago, the Sydney property market was increasing at a rapid rate of knots. 1 month there was 2%. So someone decided to write that, on an annualised basis, prices were increasing at 48%. So both ways, I think you just take these things with a grain of salt. But the important thing is that, as I say, you either do research or get someone to help you with research, because otherwise you can make some very poor decisions because you've read something in a news article. So yeah, that's where that one is. Greg, have you got anything to ask us?
No, Andrew, a great presentation. Thank you. But clearly, there doesn't seem to be a lot of distress in the market at all. I can't see any of any consequence. The commercial market across Australia has been repriced
strong
rapidly. But I suppose in good locations, as you mentioned at the beginning of this presentation, good locations still remain strong. Secondary locations probably show a weakness. But it really depends. We probably all want to look at buying in the great areas rather than the not so great areas. So we're not going to be able to take advantage of that.
And that's similar in residential, as I was saying, and maybe I didn't cover it off because I said I would. But I think some of the pain's going to come in those where they call them growth corridors. So where perhaps a lot of first home buyers really didn't over leverage them, but went close to that and bought houses, house and land packages that are 30 to 50 k's from the CBD centre. I think that sort of area will see perhaps some distress and some increased price declines, but I don't think that's really an area that we would want our clients to be looking at from an investment viewpoint. So that's what I'm saying. I think it's horses for courses. So quite often, if something becomes cheap, it doesn't necessarily make it good value.
Agree.
Yeah. Miles Tauber, are you still there?
I'm still here, Doc. Thank you. Yep.
How are you going there? Any questions for us?
No questions, thank you. No, it was a great presentation, mate. It confirmed a lot of what I was thinking out there in the marketplace at the moment. So.
And that's what I was saying. If people are looking to buy things, that's where we get some of our best data from, because it's realistic. They'll tell you, if there's plenty of stuff around, if it's cheap, expensive, etc., etc.
I think it's going to be an interesting year. I think that, there will be some pain this year, and there will be opportunities because of that pain. So, we'll see how the next few months pan out.
Yeah. Yeah, no, I agree. I think the next 6 months are probably a pretty good, if people are serious, I think it'll provide a pretty good opportunity, to be honest. All right, well, if no one else has any questions for me...
Andrew, just one more comment, if I can.
Sure.
I just came back from 2 weeks in China with the border sort of fully reopening.
Yep.
It's really, really good time for Australia right now. There's a very positive attitude in business, academia, students, and even at government levels about Australia. And lots of preferential statements about saying if they were to invest in property anywhere, it's probably Australia. So it's a good time, I think, and I think we are going to see some very positive migration, characteristics coming up.
Thanks for sharing that with us, Gary, because it's what my feeling is, and I think it's being underappreciated by markets in general or by people in general. I think it's, I'm 100% with you on that. I think it's going to have a pretty important effect on Australia, and will probably, Australia's always been called the lucky country. I think this may give us that next couple of years to maintain that type of mantra.
Andrew, if I could be greedy and build off Gary's comment,
yes.
I think your analysis is pretty clear on the pie view of Brisbane and Queensland. Do you think, given the potential of what's happening, that Melbourne could surprise on the upside with students returning, the population coming back in, etc., that we might see a kick that's not evident there right now?
Yeah, I definitely do think that, Rod. And that's why I said I'm keeping an eye on it over the next couple of months to see what happens there. But I think that's definitely the case. Yeah. Yep. It's just, I guess, if we look at what'll depend on is affordability. You know, how much is that property? You know, if it's 2 million in Sydney, is it, you know, 1 million in Melbourne? Is it 1.5? How much is it in Brisbane? A lot of it will depend on that over the next 12 months or so, because people's borrowing capacity has been diminished by the increases to the official cash rate. And that's had a fairly significant impact. In Australia, obviously more so because there's no FX effect. For a lot of our expat clients who might be earning money in, you know, Hong Kong dollars, Singapore dollars, US dollars, whatever, different currencies, perhaps much less so because they've been cushioned by the currency factor.
And with potentially another 0.5%, you know, rate rise in the next few months,
Yeah.
its serviceability is going to be even more curved.
Yeah, that's right. So they're the things. So that's what I'm saying. It's a jigsaw. There are so many moving parts to this. You know, you think you've got it right, but there are so many things you need to consider in the interplay of all those forces. But I think underlying, and that's where Gary's comments came in, I think the underlying impacts are, I'm reasonably, I'm quite constructive, I think, on the Australian economy as a whole, on the Aussie dollar, and on the Aussie housing market going forward over the medium to longer term.
Great.
All right, one and all, I hope you have a wonderful week ahead, and look forward to seeing you either at one of our Q&As or at the next review. And if you need anything, just don't hesitate to reach out.
Thank you, Andrew.
And please fill in the questionnaire and let us know where we can improve. Thank you.
All the best.
All the very best. Cheers now.